Hey everyone, welcome back to this video series on market timing. This is the third video. And what I'm going to talk about today is a very important benchmark, which is called the buy and hold. It's something that is actually extremely worth looking a little bit deeper into as a contrasting strategy to someone who is trying to actually time the markets, because in the last video we saw that there is tremendous upside if you can somehow skim even only a fraction of what's potentially out there, which I try to quantify for the case of a perfect foresight investor. So if you can skim only a fraction of it, there's still a massive upside of market timing. But a lot of people actually do struggle timing the markets. There are, let's put it that way, like hurdles in form of skills. People, in order to time markets, you have to be patient building those skills, whether quantitative skills or discretionary skills, to understand markets. And by the time you actually develop those skills that enable you to time markets, you have to be very patient for that. Or even if you have such a model, often case when you're in the midst of applying these strategies, you're not protected from drawdowns, and sometimes these drawdowns can be of very prolonged nature, and we will see that later in the second batch of videos when we talk about trend following and time series momentum, that you're actually very well compensated for these strategies. However, the cost can sometimes be stretches of underperformance to just being long the US stock market in our case. So what I'm trying to say here is that there is also a downside to market timing, a downside of like psychological nature, or just people who overestimate their own skills, try to time markets, and in the end, they're not better off than just being long and then hold on to these positions that they have. And Andrew Law, he's an owner of a fund, but also an academic. He called this artificial stupidity. And there's a very nice quote from James Grant. He said that, I mean, it sounds so incredibly obvious, but actually he observed that we humans, we're just incapable to buy low and sell high. And that's, I think, really the gist of it. So I think a lot of people will be just better off just buy and hold. So let's take a look at these. This is just one example, and that actually shows that a minority of investors are like, it's an extreme case if you want to, but it actually applies to about 10% of all investors. This is a study that is based on microdata, brokerage accounts of almost 300,000 households in the US, sorry about that, over a time period of like 13 years. And what they found was that 10% they sell at the very worst time. So they panic sell. So in a situation like actually we are today, in 2022, now in June 2022, we had a very bad start into the year, and in all likelihood, quite a few investors, they actually sold at a very inopportune time. And what's even also what's also worth highlighting is that of those 10%, 30% never come back again. So 30% never re-enter the market. There is this anecdotal example from Germany. When people look at households' stock allocation, what they observe again and again for decades now, German households have very little exposure to the stock market in comparison to, let's say, UK or US households. And some people say, and this is more anecdotal, that in the 90s, in the late 90s, there was this telecom, this TMT bubble, and when Deutsche Telekom issued its stock to the broad public, most people, they bought those stocks right at the time when the valuations were at the highest, like during that dot-com bust, and that stock actually never recovered. Even today, the values that Deutsche Telekom is trading at is just a fraction of what the values were back in 99, 2000. So a lot of people panic sell and they never come back. So it actually just shows that how important it is that if someone accepts his psychological shortcomings, let's put it that way, a buy and hold, just put on your money into stocks, a broad index if you want to, or a theme, tech, or value. Just leave it there and forget about it for the next couple of years. And so is this actually really a problem? That's a chart from the same study that shows that, as a matter of fact, when people sold, and what you have here is on the x-axis is the duration of exit. So some people, they stayed out for 40 months, others stayed out for 90 months. And these are the dots of the performance, the median return. So this is how much they missed if that number is negative, and this is how much they actually gained. So this is now an example of they sold, they panic sold, but then they re-entered the market such that overall net, they actually would have outperformed just the buy and hold. So these are the dots above these horizontal lines. But what you can see is that the majority of the dots are here in the lower part. So people, when they panic sell and they re-enter the markets, whether they sold during a crisis, post-crisis, or pre-crisis, this is what these three lines here indicate. In general, they actually are worse off than just buy and hold. So this is just an example, an illustration that I actually wanted to highlight before I go into market timing models, that buy and hold is actually a very good strategy. You can actually do pretty well, but it's also fun to try some timing models. My suggestion is, if you have something like that, a model, maybe instead of putting all your money into that strategy, just use a fraction of it, because in the process of doing it, you learn a lot about the markets and about yourself as well. So in the next video, I will now talk about more concretely about the contrarian timing strategy. So I'll go a little bit more into details of that strategy. I'll see you then. Thank you. Bye.